If you've been trying to make sense of the headlines this week,
Mhm.
you probably feel a bit, I don't know, like you're getting whiplash.
Oh, definitely.
It has been a massive week
Mm.
of just absolute contradictions. We saw stocks ending the week basically flat.
Right, kind of a collective shrug.
Exactly.
Yeah.
And yet you've got chip makers rallying like there's no tomorrow.
Yeah.
We're seeing mortgage rates hitting 3-year lows, which sounds fantastic.
Uh-huh.
But at the same time, the Federal Reserve is caught up in this intense legal drama.
Mm-hmm.
It's just a messy, messy signal week.
It certainly is, and usually when the signal is this noisy, it's because the underlying structure of things is, shifting. We're not just looking at day-to-day jitters.
Right.
We are looking at changes in infrastructure. And I don't just mean physical infrastructure. I mean the infrastructure of how we borrow money, how we power our tech, even how we define liability.
Exactly. So that is our mission for this deep dive. We're going to cut through all that noise and try to find the actual signal. We've organized your sources into 3 main pillars today. First, we'll look at the shifting landscape of money, housing, credit, and this really unusual friction between the White House and the Fed.
Mm-hmm.
Then we're going to look at the physical reality of AI, the energy, the chips, the sheer scale of it all. And finally, we'll touch on the changing rules of health and liability.
It's a solid roadmap. Because you might be listening to this, looking at your 401k or your internet bill, and wondering, okay, what is actually changing for me?
Right.
And the answer, which is kind of hidden in these reports, is quite a lot.
So let's get into it. We have to start with the macro shift. And that means looking at the Fed. But this isn't the usual, will they or won't they cut rates talk. This is something else.
Yeah, there's some serious tension bubbling up.
Between the Fed and the DOJ, right?
Exactly. And it's a story that started really small and is getting very big very fast.
How small are we talking?
It began with what seemed like, administrative housekeeping subpoenas about the renovation of the Federal Reserve's headquarters.
The headquarters?
Yeah.
Seriously?
Yeah, standard oversight stuff, checking receipts on the drywall. But it has escalated well beyond a construction project. It's now at a point where Chair Jerome Powell has actually retained outside counsel.
Wow. That seems highly unusual for a sitting Fed chair, doesn't it?
It's basically unprecedented in modern memory. Powell is explicitly warning about threats to central bank independence.
We should probably pause on why that's such a big deal.
Yeah.
It sounds like bureaucratic infighting, but it's not.
It's not at all. It's a market mechanism. The entire global financial system, it relies on the premise that the Fed makes decisions based on data, not politics.
Because if investors think the Fed is just printing money to help an election, all the trust just evaporates.
Precisely. That creates what analysts call policy risk. And we're seeing major financials like JP Morgan watching this very, very closely. They're factoring this drama right into their risk models.
So it's not just office gossip.
No. If that wall between the administration and the central bank cracks, it affects the stability of the dollar, the whole bond market. It's a foundational crack.
And speaking of market reactions, Morgan Stanley just pushed their expectation for a rate cut all the way to June now.
Which is frustrating for a lot of people. But their analysis is that the labor market is just too steady. The economy isn't cooling down fast enough to justify a cut right now.
Okay, so the Fed is holding steady. But here's where it gets really interesting for your wallet. Even though the Fed hasn't slashed rates, mortgage rates are dropping.
They are. We're looking at a 3-year low.
The 30-year fixed is down to 6.06%. How is that even happening if the Fed isn't cutting?
Well, that is the magic of the bond market, anticipating the future, combined with some very heavy-handed intervention.
Right. Redfin's reporting that monthly payments are near a 2-year low. But the sources are suggesting this isn't just the market doing its thing.
Not at all. The White House is getting involved with some very specific, very aggressive policy maneuvers to force that number down.
And this is a critical piece of the puzzle, right?
It is. The administration isn't just hoping housing becomes affordable. They're trying to engineer it. First, they've directed Fannie Mae and Freddie Mac to buy $200 billion of mortgage bonds.
$200 billion. That is a massive number. So break down the mechanics. How does buying a bond lower my mortgage rate?
It's just supply and demand. Mortgage rates are tied to the yield on these bonds. So when the government steps in and buys a huge amount of them,
Flooding the market with demand.
right, the price of those bonds goes up. And when bond prices go up, the interest rate goes down. It's a lever they can pull to artificially suppress rates. A direct intervention.
So they're just being the biggest buyer in the room to force the cost down.
That's it. And
Mhm.
that's not even the wildest part. The sources are also mentioning a plan to let people use their 401k funds for home down payments.
Whoa. Okay, that's a huge philosophical shift. I mean, retirement accounts are supposed to be the do not touch vault.
They are. The tax code is designed to punish you for taking that money out early. But this proposal would unlock that capital to solve the immediate housing crisis.
The logic being that the down payment is the biggest barrier for most people.
That's the logic. Not the monthly payment, but that big chunk of cash up front. They have the money, but it's locked in a 401k.
But isn't that dangerous? You're taking money meant for when you're 70 and spending it now.
It is risky. You're leveraging your future security for a present asset. The counter-argument, of course, is that a house is a retirement asset.
Sure, if you own a home, you're not paying rent in retirement.
Right. But there's another risk. If you suddenly flood the housing market with all this 401k cash, you crank up demand. But if you don't also build more houses, what happens?
Prices just go up. More money chasing the same number of homes.
Exactly. So it's this really complex dance. The Fed trying to stay independent to keep inflation down, and the White House pulling these huge levers on housing.
And that theme of government designing financial products, that carries right over into consumer credit too.
Oh yeah, this was a fascinating pivot this week on credit cards.
So we started with this idea of a hard cap on interest rates.
Yeah.
Like a strict 10% cap.
Which sounds great to the consumer, but, predictably, the banks hated it.
Of course.
Citigroup and others pushed back hard. And their argument is simple math. High interest rates cover the risk of lending to people with lower credit scores. If you cap them at 10%, they'll just stop lending to anyone with a score below 700.
So the policy would backfire. The people
Well-
you're trying to help get cut off completely.
Exactly. The credit dries up. So the pivot happened. Instead of just a cap, the administration is now floating the idea of what they're calling Trump cards.
Catchy name.
It is. But the mechanics are what matter. These would be bank-issued cards designed specifically for underserved consumers.
So instead of telling banks you can't charge more, they're saying create this specific new product.
Right. It's a shift from restriction to creation. It keeps the credit flowing, which the banks want, but it tries to offer a lifeline to people who are just drowning in 25% APR debt.
It really feels like a redesign of how money flows to regular people.
Hmm.
But let's switch gears from money to the physical world, the iron in the ground moment.
Yes. This is where we leave the spreadsheets and go to the actual construction site.
Because everyone's talking about AI software, but the sources this week are screaming about hardware. We have Micron breaking ground on a memory megafab near Syracuse, New York, a $100 billion investment.
$100 billion. To put that in perspective, that's the GDP of a small country being poured into upstate New York.
The timeline is long, right? This isn't for next year's iPhone.
No. Production targets are around 2030. This is a multi-decade bet on American manufacturing.
And it's not just domestic companies. There's a new U.S.-Taiwan accord that just locked in, $250 billion in U.S. investment from firms like TSMC?
A staggering number, and there's a distinct policy carrot attached to that. The deal caps tariffs on their goods at 15%.
Which China is heavily criticizing, by the way.
Of course, it strengthens the U.S.-Taiwan bond. But from a U.S. perspective, this is all about securing the supply chain. You get the factories here, you cap the tariffs, and you secure the chips you need for AI so you aren't reliant on shipping lanes across the Pacific.
It's national security disguised as trade policy.
Exactly.
But here's the catch. You can build all the chip factories you want, but they're useless if you can't turn them on. Which brings us to the energy crisis.
This is the constraint that 2 years ago, nobody was really talking about, and now it's the only thing that matters in Silicon Valley.
These things are just power hungry.
Incredibly. An AI data center uses exponentially more power than a traditional one. You can't just plug these things into the existing grid.
The demand is so high that the administration and northeastern governors are asking PJM, the grid operator, for an emergency option. They just need power.
And look at the solution being proposed. It's not just let the utility companies build it eventually. The proposal is for big tech Microsoft, Meta signed 15-year contracts to finance new power plants directly.
That blows my mind. We're talking about Facebook and Microsoft acting as utility backers.
They almost have to. The utility companies are risk averse. They don't want to build a billion-dollar plant without a guaranteed buyer. Big tech is saying, we'll buy it, all of it. It's an existential requirement for them to win the AI race.
It's like the railroads building their own coal mines back in the day.
That's a perfect analogy. Vertical integration, because the public infrastructure just can't keep up.
We did see one green win this week, though. That Avangrid hydropower link from Quebec to Massachusetts finally went live.
Finally, that's 1,200 megawatts, and the key word there is baseload.
Right. Explain that for the non-engineers.
Wind and solar are intermittent. The sun sets, the wind stops, but data centers need constant, 99.999% uptime. Hydropower provides that steady, always-on baseload that balances the grid. Getting that Quebec hydro flowing is a huge relief.
So Microsoft is paying for power plants. Chip makers are building $100 billion factories. Someone has to pay for this. The money's got to come from somewhere.
Uh-huh.
And that brings us to the digital experience. Because guess who's going to help pay the bill?
I have a feeling it's the user.
You got it. OpenAI needs to make money. We saw reports this week they're going to start piloting ads in ChatGPT.
It was inevitable, right? The infrastructure spending we just talked about is too high to rely only on $20 subscriptions.
So here's how it breaks down. The free tier and the $8 Go tier will start seeing ads. Plus, and enterprise users stay ad-free for now.
It's the classic playbook. Get everyone hooked on the free product, and then introduce monetization to cover the costs. And remember, they are in a massive talent war, too.
Oh, right. They're rehiring researchers from Mira Murati's venture, fighting off Meta. Some of these people are getting salaries in the millions.
They are. It's simple supply and demand again. There are only a few hundred people on Earth who can build these models. So you've got high energy costs, high hardware costs, and astronomical people costs. Their revenue has to come from somewhere. Ads is the oldest answer.
It feels like the end of the magic era of AI and the beginning of the utility era. Now it has billboards.
That's a great way to put it.
Speaking of ads, YouTube is actually going the other way. They're easing their monetization rules.
This is a big deal for creators.
Yeah, they'll now allow full ads on non-graphic, dramatized content about sensitive topics.
It's a response to the apocalypse fears. Advertisers used to be terrified of anything controversial, but YouTube is realizing if they're too strict, they strangle their own content pipeline. This is them trying to find a middle ground.
So YouTube opens the gates, OpenAI puts up billboards, and meanwhile, the platforms themselves are a bit wobbly. We saw a global outage at X this week.
Right, took down the feeds and their chatbot, Grok.
But what I found interesting was that Tesla shares were totally unaffected.
That's a key observation. It tells us investors have finally compartmentalized Musk's empire. A few years ago, those stocks moved in lockstep. Now, the market sees the chaos at X as separate from the car business at Tesla.
And we can't forget the Verizon outage. Nationwide disruption. They're offering a $20 credit, which is nice, but I have to laugh. It's not automatic.
Of course not.
You have to go into the app, log in, find a specific link, and claim it. It's just enough friction that they probably save millions on people who just forget.
That is breakage by design. Friction is a powerful financial tool.
Okay, let's move to our final pillar, health and science. The weight loss race is heating up again.
It never really cooled down, but the news here is about the delivery method. Novo Nordisk has launched the oral Wegovy pill.
And it's off to a solid start, thousands of prescriptions in the first week. Why is the pill form such a big deal?
It's the psychological barrier. A lot of people are just terrified of needles, even the tiny pen needles. Taking a pill is normal.
So this is all strategy. They're trying to recapture market share from Eli Lilly before Lilly can launch their own pill.
Exactly. If they can dominate the oral market, they secure their lead. It lowers the friction for the patient.
But the industry mood overall seems, cautious.
Bright but cautious was the phrase from the JP Morgan Healthcare Conference. Majors like Biogen are signaling discipline. They're not just throwing money at everything like they were during the pandemic.
And while they're counting prescriptions, there's a massive legal battle brewing that could change the rules for everyone. The Supreme Court, Bayer, and Roundup.
This is, legally speaking, the heavyweight fight of the year. The Supreme Court has agreed to hear Bayer's appeal.
So remind us what is at stake here. It's about the warning labels, right?
It's about failure to warn. The core issue is this. The EPA, the federal regulator, reviewed glyphosate. They looked at the science and approved a label that did not have a cancer warning. In fact, they said a warning wasn't necessary.
Okay, so the feds say no label needed.
Correct. But state courts have been allowing lawsuits claiming Bayer should have warned people anyway under state laws. So Bayer is asking the Supreme Court, if the federal government told us not to put a warning on, How can a state sue us for not putting a warning on?
That seems like a pretty valid question. It's the supremacy clause, right? Federal law trumps state law.
That's the argument. If Bayer loses this, it reshapes liability for every company with an EPA-approved product. Pesticides, chemicals, medical devices. It would mean federal approval might not protect you from state lawsuits. It's a patchwork of liability that companies are terrified of.
Wow. So from the Supreme Court to the power grid, the rules are being rewritten in real time.
That really is the through line, isn't it? We're in a transition period where the old infrastructure, legal, physical, and financial is being stress tested.
So let's just recap. We have the government trying to unlock the housing market by tapping into our retirement funds. We have big tech being asked to finance the power grid to keep AI alive. And we have chatbots showing us ads to pay for it all.
It's a closed loop, in a way. But if we step back, I want to leave the listener with one last thought.
Go for it.
We are seeing this blurring of lines that we haven't seen in a long, long time. If Microsoft is funding public power plants and the White House is designing specific credit card products, are we moving toward a world where the distinction between a public utility and a private product just doesn't really exist anymore?
That is a lot to think about. Are we citizens or are we just users with a credit line?
That's the question.
Well, on that cheerful note, thank you for diving deep with us today. Hopefully the signal is a little clearer now.
Always a pleasure.
Catch you on the next wave of information.